first off, thank you so much for taking the time to speak with us today. We recently published a piece about Offdeal, and we were really impressed by how the firm is reshaping the M&A landscape for the SME market. Our goal with this conversation is to go a layer deeper to better understand how the model works in practice and what makes it scalable, and where you see the biggest opportunities ahead. We want to keep this conversational, and we'd love to touch on deal dynamics, client mix, tech stack, and your perspective on the industry. So, for our viewers, can you start off by sharing a bit about your role at Offdeal and what drew you to join the firm?
Yeah, so essentially I'm a banker here at Offdeal. So sell side M&A, we help sell companies, kind of the 1 to 15 million of EBITDA. Actually 1 to 20. I think we have one deal, a couple deals over 15, but yeah, 1 to 20. My job really is to do anything from closing the customer to winning the customer, now his client, to doing the diligence on the company up front, doing the financial model, or gathering all the documents, doing the pitch deck, to finding the buyers, to negotiating with the buyers, getting the offers, and then working with the owner to figure out which one to accept or not accept, and then close the deal. And then along with building relationships with private equity firms, understanding what they're interested in, also learning about industries and getting smart on them. And it's pretty much the whole job. But the banker at Offdeal is a lot different than a banker, of similar age at other banks, because even because we actually have responsibility. We're the sole banker on deals, and we kind of have like a hedge fund model where you have like a lead banker and then supporting bankers, versus a traditional deal team is 5-6 people on a deal, right? And like the associate analysts get told what to do. Well, here at Offdeal, there's no one that tells you what to do. You just got to do it. So it's very entrepreneurial. And basically, the idea here is that we think that you only need one competent banker plus AI plus maybe a couple supporting people, but you don't need like 5, 6, 7 people on deal teams to do a transaction. AI is good at doing a lot of the work of the junior people. And then why I chose Offdeal was, well, I mean, I've always been interested in startups and early stage companies. I've never really been a big corporation guy. I like to have responsibility to do things. I kind of like chaos a bit. Just the whole big company thing. 9 to 5, check out of the door was just never been interesting to me. And so yeah, joined the Offdeal after I did banking at a previous company, and then did my own thing for a bit. And yeah, it's been fun.
Yeah, I also noticed you've written a book on AI.
Yeah, I wrote that back in 2020. I started writing it. I think I published it maybe early 21.
Oh, so this
But
is way before the LLM hype.
oh yeah, I mean, this is before even ChatGPT was like out and usable. Like a lot of people think, oh, you wrote the book with AI. I'm like, no, I didn't even. I wrote about ChatGPT back then, but I never used it. Like I this was well before that. So yeah, I knew the AI had cycle was coming long before most. I mean, I was reading about it, kind of understood it, that both would impact blue collar and white collar.
Mhm.
I think some of the things I got wrong was that I overestimated the timelines on AI within like physical hardware and like robotics and transportation. Like I thought self-driving would be quicker than it was, and et cetera, et cetera. But
Right.
the thing I got right was definitely its impact on professional services, and that we see it today about every company is using it and weaving it in and investing in these AI tools, and it's definitely exciting. But yeah, so I wrote that back in 2020.
Yeah, right. I can also see that in the tone of Offdeal. You guys call yourselves an AI native, M&A advisory, not an M&A advisory that uses AI tools. And I believe there's a huge difference in that. So how long do you think it's before the big corporates sort of catch up in the use of AI?
Well, mm, Well, it's kind of, I'll break it down. So like if you talk about the big corps, like the JP Morgans, the
Right.
Morgan Stanleys, the Evercores, well, they already are adopting a lot of AI tools, but we don't really compete with them, number one. And number two, it doesn't move the needles much for them because they do large transactions. It's not like super high volume, right? It's more relationship driven. Like they know the five buyers that these billion-dollar companies make sense for. So, like, sure, AI will do the work, but it's not like they're competing with us. Doesn't mean like they're doing thousands of more deals. It's just
Mm.
they do the big deals, right? And so they'll integrate it, but I don't really think anything will really change in terms of org structure and company. Ori has a good post in this, the CEO of Offdeal, about how like, the thing they really need to innovate on is org structure and deal team structure. Right now they have the bureaucracy chain, and you know, that's the biggest inhibitor to change and the work of the actual banker, not really AI. So I would say they're going to do that, whatever. But the thing, the more relevant thing to off deal is like, when will these like boutique M&A firms and these smaller, you know, firms that do, 10 to $100 million, $200 million deals, $300 million deals, when will those people adopt AI? Because they're more competitive to us. And, they're all looking at it. Like we talk to them, they're all, got their committees to try to like weave in some tools. I mean, right now, a lot of it's just, they're using a ChatGPT subscription, right?
Yeah.
Yeah.
And like ChatGPT Enterprise, or some people are trying like Rogo or Heavy, or blah blah blah. Well, I mean, I've used AI tools and that are specific for banking. And I tried to build one. That was the company I did, for a few months. I built prototypes, did it myself, and they're fun. They're good research tools, but they're not really automating work away. Like you've never read a headline that says, um, you know, boutique investment bank lays off all their employees and replaces with AI because they use, Rogo or Hebia.
Right.
So it's just not a thing yet. But we'll see what happens. I think the important thing to realize is, um, the reason why Optio is different is it's AI weaved into every part of the workflow. So like AI native means every part of the software that we build at Offdeal and use is personalized to us in AI. So our CRM, our database, our pitch decks, our financial models, our CRM, every single thing is built by our engineers, connected AI. Versus what are these banks going to do? They're going to buy off-the-shelf software. So like
Right.
an AI native CRM, AI buyer search tool. Then it's going to be maybe a pitch deck slide builder, but they're not connected. So really, they're not going to move the needle. It's still going to be a human using the tool and like copying, pasting documents, like putting into a different tool. The thing that's off deal is all of our systems are connected. They're all connected. So like our CRM is connected to our pitch deck maker, which is connected to our database, which is connected to our CRM, which is connected to our email client. Like we don't use off the shelf software. We have no CRM that we've bought, no deal cloud, no
Wow.
PitchBook, no nothing. It's all our software. So that's the big difference, and what allows me to be on 14 deals and be on like a 1 to 2 person deal team, versus typically these people at other banks are on 6, 7 deals and have 6 people deal teams. So we doing more deals and less people on the deal, so double. And that's because of the AI in the loop. And so that's a big differentiator. So these banks will try to adopt it, but I really don't think it's going to move the needle. And the bigger thing is, I'm not sure if it's going to help them win deals because, like, what are they going to possibly do? Write more cold emails? Well, like, owners don't really respond to those anyway. And so, I'm trying to figure out like what edge it gives. I mean, a lot of the deals you win now are like relationships, like marketing, getting the word out, partnerships, and AI doesn't really impact. So I think a lot of these banks will adopt it, but again, they're not technical people. They don't have engineers, so a lot of them are. I'm hearing are trying to build custom software and like hiring random devs off Fiverr and these some of these marketplace, and it just doesn't work. Like this is really hard stuff to build. I mean, Deal Cloud and Data Site, they have hundreds and hundreds of engineers, employees, and billions of dollars of capital, and blah blah blah. You think some bank is going to hire offshore devs or someone off the street and rebuild these systems? Like it's not easy. We're doing it off deal, but it requires a lot of venture money, a lot of time, a lot of effort. 20-hour days, and so it's not easy stuff. So I think it's gonna be a long time before these firms do anything substantial. And even if they did, I mean, I think we'd still all compete and not win them. At the end of the day, it comes down to talent and like work ethic and like a growth mindset. A lot of these boutique firms, they're just happy doing, X amount of deals a year, or keeping the employee count, roughly the same, maybe adding a couple people, but they're not like in startup mode where
Mhm.
it's like we want to at Offdeal, we want to be a $10 billion company, which means we need to hire like crazy, we need to do deals like crazy, we need to move with urgency, we need to work long hours. Like that's having that startup mindset and that venture backing is like incredibly important for speed and pace and ambition. We're not a boutique firm trying to just cash out and grow at a modest pace and play golf. So that's like a big difference. I know it was a long answer, but that's how I view it.
Right, it's all about going all founder mode.
Yeah, that's well, it's sort of like that. I mean, like we could have the same. Even if you gave us and if you gave off deal and like gave our software to another firm and like tried to compete, who knows if but I think it still comes down to effort and people and like what's the ambition and goals of the company.
That makes sense.
Like we make decisions to try to be a big company, not to optimize for this year's cash flow or whatever. I mean, we make decisions to try to grow really fast. um so yeah.
So you mentioned that Offdeal's changed the org chart significantly. So on average, how many deals do you think a typical Offdeal team runs at the same time? I know you mentioned you doing 14, but is that the average for every single team
I
in Offdeal
mean,
or?
right now, sort of, yeah. I mean, I'm on the most by far, but yeah, I'm 14. But I think it's usually going to be around, I'd say 7 to 8. But we're going to be doing bigger deals. Like we're moving up market a bit now. Like we started out doing little smaller ones. Now we're moving up and up and up. I think we want to stay in this kind of wheelhouse of 1 to 20 of EBITDA. Usually around like 5 to 10. I think is really good. Which I think 7 to 8 is the right number. Because normally like a boutique for those size would be 6 people and like 6 deals. And so when we only have like 1 to 2 person deal teams, I think 7 to 8 is good. 1 to 2 person deal teams plus AI, 7, 8 deals. Because it's not like a prize to be on more deals. Like yeah, it's fun, but and maybe you make more money as a banker, but at the end of the day, quality matters. And like you can't automate certain things of the work, like buyer calls, like calls with owners, right?
Yeah.
Yeah. So how do you divide, I guess, what deal which team is going to do? Like, do you guys specialize on like industries or any products? Like, what is the org
Um,
structure like?
no, right now we're pretty industry agnostic, but largely industrial services and industrials. So, um, like an example is like paving companies or like a waste transportation company or a logistics business or a manufacturing company. We have a couple consumer, some in business services, but largely industrials. I think is where we find the most action. Um, and we're keeping it pretty broad just because we want to see what hits, what sticks. Learn more about a lot of different industries. We don't want to be like okay, we're only doing healthcare because what if we make the wrong bet on healthcare, right? Or we only want to do consumer, like so we're bankers are spread out. They're all different. We don't segment by like there's no healthcare banker, no consumer banker. But over time, we'll definitely specialize by deal teams. Like someone will be the healthcare team, someone will be the industrials team. But I don't think it's gonna be like super specific. But eventually we will, but just not right now.
Right. Also, I've read that Offdeal aims to get to 100 million revenue rate by 27. So to get to that, what's the bottleneck? Is it the tech or is it the people?
Um, well, good question. We can get there in people. So if we just hired a lot, definitely we could just do it with no tech actually. Now to get there quicker with
I think in a more sustainable way.
Right, like most sustainable. I mean, like we need tech to improve definitely. Like we need more stuff to be built out. Like what we have is great now, but needs to accelerate, a bit. And then yeah, I mean it's kind of both. Like for example, um, if what does 100 million by 27?
Right. I read.
Is that what he said? So for example, I mean if you have if one banker's doing $10 million in fees, uh, you need 10 bankers to do 100 million. And then how do you get to $10 million in fees a year? Well, um, if you do,
It's like 20 deals a year.
well, no, I mean, even if you did three $60 million deals,
Okay.
that's
Yeah, right.
what 9 million.
Yeah.
And $6 million deal. Okay, what does that mean? That's a $10 million EBITDA deal times 6x multiple, but more likely it's going to be like a $8 million deal times like an 8x multiple, or so I don't know. Like that's just putting the perspective view on if you use a banker, let's just say this is low, but just use it for okay. Let's use your example of let's say you're on like 15 deals. Let's just assume half don't transact, right? Whether you delay it or just doesn't work. So you're on, let's just say 8 deals then, or so 8 deals close. Of the 8 deals, yeah, maybe 3 are like whale or bigger ones. So they're like $60 million deals, and they close. That's 9 million, and then a few more close, and they're in the 200K fee, 300K fee. Well, I mean, it adds up to around 10 million. And if you have 10 bankers, they all kind of do the same performance. You keep the right SOPs, that's 100 million right there. That's a lot of that is in profit too, right? Now, in order to get to that volume and that execution, the tech needs to be built out a little bit more so we can increase the throughput on deals and to keep being on more deals.
Mhm.
Two, we need to like keep winning bigger deals, which means you need to have proper headcount, have BDRs and sourcing, right? Like right now we are way under capacity. Like we could triple headcount, still be extremely busy. Like we need way more people. So like yeah, one blocker to 100 million revenue is just like needing to hire more people. And I think we have a really high bar for hiring. So like we are kind of slow with hiring, but we definitely could hire way more bankers. And if you really want to get 100 million, you could just have double the bankers. Instead of 10 bankers doing 10 million fees, you could have 20 bankers doing $5 million in fees, right, or something. So I mean, we can figure it out, but that's definitely the approach. Is like figure out the calculator or the formula to how you got to get there. But it's definitely possible. Like it's not crazy at all. Just got to bring the tech up, get the people in place. Yeah.
Absolutely. And also I've also read about 45-day deals, and someone receiving 71 sort of letters of intent and stuff like that. So it's amazing velocity. So in practice, this whole hybrid system where you have tech and people, what process would you say would take the longest in your current timeline for a deal?
Um, Probably diligence, like buyers doing diligence, like answering the questions. I mean, making the pitch decks is super quick. I mean, creating the buyer list is super quick. Um, but the biggest bottleneck to us is getting information from clients. So like we need the P&Ls, we need the equipment list, we need the asset list, we need their customer data, we need their project data, we need the project data with margin, we need commentary on why this happened. Like getting all that data is very difficult for these smaller companies, right?
Right.
Obviously, for a public company with financials and like full-time people and blah blah blah, it's easy.
Right.
For large companies with full teams, hundreds of employees, yeah, it's easy. But for a 20-person, paving business or 20-person, waste transportation deal where they're blue collar people and don't have like it's tough. It's tough to gather these documents. They've never done this before, so like pulling all this stuff together is sometimes a bit tough. And so that's what slows down deals is waiting for documents, gathering it. Offdeal's process itself is pretty lightning quick, but there's natural times to do outreach, to set up buyer meetings, in-person meetings, site visits, diligence. It just takes time, but we can definitely collapse the deal process from a typical bank by 50, 60%, for sure.
Right, right. And that's another straightforward question. So what percentage of deals that launch, typically close successfully? Because I think you're going to be optimizing for a very high closure rate, considering the lean team you have. So what percentage of deals naturally close successfully?
I think it's probably going to be around. What's tough question. I think because like we pretty much only had like one die out of what 40 some. So that's really good. So like a deal's really never dead until like they give up trying to sell. Like sometimes it may not transact in 3-4 months, but it'll transact eventually, right? Sometimes you want to wait, delay it 3 months to get more P&Ls because you have a good month. And so like I think 70-80% should transact, like have an outcome. Just who knows what time period. As far as like who's gonna transact in like an appropriate amount of time, I don't know. I think it'll probably be a little bit better than industry standard. So yeah, 50-60%. I think that'd be good. Doing deals are tough. There's a lot of factors, right? You need to win the client. You need to get a buyer. You need to have a appropriate price that the buyer is willing to pay, plus what the seller is willing to accept, and then due diligence. There's a lot of. It's not easy, but I think that's probably going to be around the percent.
Do you notice any patterns of seasonality? Are there any busier storms
You broke up there.
for
What
deal
was
making?
that?
Do you notice any patterns in seasonality? Are there any
Oh,
busier or slower months for
that's a good
when deals happen?
question. Yeah, that's a really good question. We don't know yet because we haven't been a full year in operations, but yeah, so there'll definitely be seasonality around, December and Christmas time, New Year's. There's seasonality in August, so August was very slow from getting answers from buyer perspective. Labor Day and blah 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 vacations. The busiest months will definitely be right now, so like September, October, November. Um, February, March, April, they'll be busy. But yeah, August and December probably the two slowest months.
Do you think the tariff-induced uncertainty is going to negatively impact any of Offdeal's businesses? Or
No,
at the
it
moment,
affects
you don't
everybody. It's
really
not
see
just
anything
off
happening?
deal. No,
Yeah.
because it affects everybody off deal. Every bank. We're not like it's just not related to off deal, but yeah.
Right.
Um, so I wanted to ask, how does valuation multiple like typically differ between the smaller deals that Offdeal works with versus the large M&A deals that the bulge brackets or the boutiques do?
Um, it's a good question. So larger deals typically have larger or higher multiples. Like if you're doing a paving deal, a paving business, for example, if you have a $2 million revenue paving business versus $100 million revenue, well, all things equal, the larger one will have a higher multiple for obvious reasons. But there's definitely cases where a smaller deal can have a higher multiple if it's got better qualities than a larger deal, like if it's got recurring revenue or big contracts or no customer concentration. Like those factors can have a higher multiple than a larger company with maybe customer concentration or something like that. The way we think about multiples and valuation at off deal is you know the multiples that buyers pay is all it's pretty much a risk factor. Like the less risks there are in a business to it failing, the higher the multiple. That's why Nvidia and a lot of these and Google and Apple, they trade at these wild valuations because they're the world's best companies and there's no really risk to them, so they trade at high multiples versus some of these crappy like food businesses or whatever that they go bankrupt all the time. Like Noodles and Company. They trade at tiny valuations, and Dunkin' Donuts and Krispy Kreme. Because they're forced companies. So multiples really are all about risk factor, and smaller companies usually are more risky, so they trade at lower multiples than bigger companies with more scale. So that's how we really think of it. But I would say like in more practical terms, so like there's not too much difference between like a you know $4 million EBITDA valuation to like a 15 million or like 10 million. Like if it's the same sector. But different sectors have different multiples. Like for example, insurance brokerages right now, even for tiny ones like 500K to million, you're getting 10 times EBITDA. And then CPA firms are trading at good multiples now. You get IT MSPs, those trade at crazy revenue and EBITDA multiples. So it's just different things. They're different, hot versus like then you get things like painting contractors, which it's painting. It's a couple guys in a bucket. It's 2.5, 3 times. So depends on industry, depends on size, but all things equal, smaller deals, a little bit lower multiples.
Okay. That makes sense. How do you find, I guess, comparable transactions in like the SME space? Because
Good question.
I'm not sure if there is any centralized database that like tracks SME M&A.
Yep, you're asking good questions. So we have like our own proprietary database, sort of like PitchBook, kind of built like a PitchBook competitor. So like we have all the data that PitchBook has, we have all the data that Grata has, we have all the data that the public filings have. So we just combine all those. Then we also have there's like data providers out there that like that aggregate these small business data. When they sell, they report it. To these agencies or there are some databases out there that have this smaller business data. Part of it's like proprietary too. So like we make the rounds and do hundreds and hundreds and hundreds of conversations with private equity firms, and they kind of tell us what certain companies got acquired for. And so we store all that information and start to create kind of proprietary data. So it's a mix of off the shelf kind of data providers. It's a mix of existing data vendors and also proprietary data. So like there's a lot of reports online. Like we will scrape the web and grab some of these banking reports that you'll see where they do these reports on med spas, for example, and then the last couple pages will have like a table of comps, right? And we scrape those. So we aggregate all the data we possibly can. And there's also ways to kind of calibrate things like, just based on conversations and, looking at the public companies and kind of just working down from there and down from there. And you'll kind of understand the multiples of certain spaces and, how they trade.
Right. I understand. So another question I had was, your model is built on a pure success fee, with no upfront retainer, from what we gather, and that's very rare. However, this means that, Offdeal bears 100% of the cost of a deal that does not go through. So how does this shape your client selection process? What are those red flags you look for that might lead you to, like turn down potential sale?
Right. So back to your question, one of your first questions of how does Offdeal get to 100 million in revenue and what blocks that? Well, another thing I'm just thinking about, what blocks that would be bad deal selection. For that exact reason is like we need to be incredibly smart about what we take on. And I would say early on we were not too aware of that. And part of this is more reps too. The more reps you get, more deals you do, you'll figure out what's sellable, what's not sellable. That's how we do so many conversations with PE firms to understand like what are they exactly looking for, so that informs what we take on. But yeah, you're exactly right. I mean, if we do a deal and it's 6 months, all hundreds of hours work, all this stuff, and it doesn't transact, we get paid zero. Not 10K, not 20K, not $500, zero. And so we pay people pretty good here, so that's a lot of money to not have anything happen. So so we think of it like a formula, like not having any fees up front definitely increases our ability to win deals. And it's kind of like a formula, like you can either have we make up for it by getting these bigger deals sold that we normally wouldn't win with maybe a retainer fee, and so it's just kind of a trade off. But we feel that the having the no fees up front way outpays for having retainer fees and stuff like that. And plus, being venture backed, right? You can kind of be a disruptor, and worst comes to worst, you can take losses on deals, and just because it doesn't matter, you have a lot of funding versus maybe some of these 10-person investment banks. They can't afford to have a period of time where 5 deals close because they'll close up shop.
Right.
Versus we could lose money for 5 years and never have a deal, and we could still not run out of money. But not saying that's ever going to be the case. Like, we're already profitable, but like that's kind of the theory behind it. When I started my first month, we actually had like a $500 nuisance fee for like 6 months, and man, it was about the worst thing in the entire world. Like, I hated sending out the Stripe form for it. Owners just complained about it. They said, this is ridiculous. Like, you're gonna make 500K in my business. Why are you charging me 500K or $500? And like, it didn't move the needle for us anyway. Like, it's less than a week of Uber Eats orders. So it's like, it was so dumb to have it. But the reason why we had it was to just weed out tire kickers. Like, if you're a business owner with a $30 million business, $500 should be nothing. But like, if you're just trying to sign up with Offdeal to get like a free market check type
Mhm.
thing, then
Right.
it would waste our time. But we've quickly realized that like, owners themselves don't want to waste time. Like, there's no such thing as an owner that wants to go through all these calls and meetings and emails and texts just to hear what the market thinks about their company. Like, that's just not really a thing. And we do a lot of vetting too, like understand people's motivations, like why they're selling. Like, we try to do a lot of vetting. But that's a great question, that we need to be extremely smart about what we take on, like very, very smart. And that's something that I increasingly care a lot about. It's hard to turn down business. It really is, especially when, it's 50-50 whether it could sell or not. But what you really need to optimize for is like slam dunks, especially early on. But you're right, got to take on smart deals, and there's a lot of factors that go into that. Um, the biggest for me being size. Like, I want to do the 4 or 5 million EBITDA deals plus, because as a banker you get paid way more money. They're more sophisticated. The buyer pool is bigger.
Right.
You have financials, you can get data quicker. Like, doing bigger deals solves all the headaches up to a certain extent. Now, once you get into the 25 million EBITDA, well, then you have to have so much competition, and also like maybe requires a little bit more hands-on, and more and more of this. And so I think our sweet spot really is 2 to 15 EBITDA, and I think that's good because Offdeal can make a ton of money on them, bankers can make a ton of money, and also we can win them. So that's kind of our sweet spot that I've identified, for sure.
Great.
Yep. So when you're applying these AI-driven models to new industries, I guess a question that I can think of is, how does the model's effectiveness change based on different sectors? For instance, like, is it more effective in fragmented industries with small players like HVAC, or is it more effective in like consolidated ones with bigger players?
Good question. I would say probably better with the ones with more bigger players, and not the fragmented ones, um, just based on general experience so far. But I would say it doesn't matter too much. I mean, I don't think it's like a big issue we're seeing. Um, I definitely think like um, information transparency, and like we get more data on like the obvious things. Like, everybody knows roughly what HVAC businesses trade for and what happened, who the buyers are, because it's such a liquid market. There's so many of them, so many that trade. Versus if you're doing like a nuclear cleaning business, which we've come across one, like there's like 6 companies out there and not much M&A activity, so you don't really know what the multiples are or who the buyer. So the more liquid the market is, the more data you have, the more information you have, but it's also more competitive. So like, winning a HVAC and plumbing business is more competitive because every business broker, every bank, knows that they're hot, so they want to take them on. So the owners get like hundreds and hundreds of emails and calls, versus some of these niche things like a sleep lab or uh, you know, you know, eco waste recycling company or something. Like some of these things were not super obvious. That's where kind of the edge is. But the difficult part is might be a little bit trickier to sell. So you kind of want to play the edge of going after the hot stuff, but also finding the companies that maybe are a bit overlooked. Like there's actually, believe it or not, there's a lot of really good companies of size in the United States that are not in like the common databases, like a PitchBook, uh, LinkedIn. Like some of my biggest clients hardly even have a LinkedIn page. They get crappy websites. Sometimes. So like there's a lot of like overlooked companies that are not on the web or obvious to people. And so how do you find them? It's like word of mouth. Getting the word out, getting inbound, so they come to you. That's usually the easiest way. Um, and that's where so that's another thing to write about, or to this is probably the most important thing to me actually, is Offdeal's big sourcing edge and winning business edge is our marketing. And only Offdeal can really do this because we are venture backed and are buzzy and have AI. That's the big edge. So if you compare us to 9 other boutique investment banks, they cannot do marketing. Like they can't do TV appearances, they can't do Twitter, they can't do LinkedIn, they can't do podcasts, they can't do Google ads because nobody will care. Nobody in the history of the world would ever listen to a podcast or read tweets from some random bank in Kansas City. I mean, what are they going to write about? And no one, and the banks themselves don't want to do it because they're not like, that's not their thing. Versus Offdeal, because we have like an AI edge and buzzy and fun, what we're doing is innovative, and we're younger guys. We can do Twitter, we can do LinkedIn, we can do podcasts, we can go on TV like CNBC, we can do Financial Times articles. Probably go on Fox Business in a short period of time here. We'll do more podcasts. I had a tweet this week. If you look at my Twitter, I had 1 million views on the tweet and
Right.
almost 10,000 likes.
Yeah,
And
I
like
this morning, yeah, it turned up on my
yeah,
feed.
yeah. Thank you. Yeah, thank you. And other bankers and like, it's not even related to banking or off deal. It's just like being out there. People
Right.
click on your stuff. They find your LinkedIn. So like doing that marketing is incredibly valuable. And our competition can't do it and won't do it. And that's how you win deals and get more sourcing, is by doing that type of stuff. And so I think we're going to continue to be on social, to do marketing, to do LinkedIn, because you get the word out, and that's how you find these under non-obvious companies. Because it's kind of a fool's errand to try to get your leads from hitting the cold calls every day and cold emails. And, hey, business owner, would you like to sell? Like that's not appealing. Like the way to truly get good leads is like doing cool stuff, getting the word out there, announce some deals. We actually have a bias against like announcing deals too. Like a lot of banks will do these like case studies and all these posts about them. A lot of our owners actually don't want the word out there about that. Because a lot of our owners actually continue to run their company, like they sell a majority stake. We
Right.
don't think it's necessarily appropriate to announce all this stuff, like our closed deals that we've done. A lot of banks, they love to claim it because that's how they win deals. It's by these tombstones and credits.
Yeah,
We'll of course talk about them like in private, and we're happy to give referrals and references, but I don't think it's appropriate that we're gonna like list them all on online and just like out these owners that they've done certain things. So I think that's an important thing. Like we get some people like, oh, didn't see any deals on the website. Well, number one, we're pretty new, and number two, we have a pretty big bias against announcing all this stuff because our clients don't like it, and we try to be really good to our clients. Like we've had pretty much no negative feedback. Like I said, we've only had one deal kind of fail out of 40 some. Or fail meaning like we just gave up trying to sell, and
Right.
and so like we have a really really good customer satisfaction rate, good NPS score, both pre-clients and clients. I think it's because we work hard, we're young, we hustle, we really care. And they also know we put our money where our mouth is. Again, we don't charge any fees up front. So like, look, we work our ass off to try to get things done. If it doesn't, it costs owners $0. And so they appreciate that. We'd probably get a lot, these people get negative feedback, a lot of these banks and brokers and stuff, because they charge these 75K, 100K fees up front and high fees in the back end, and they don't do anything. They just sit around and eat chips all day. And so like we work hard to get things done quick. So I think that's a big edge. is that like why would we take on a deal and not work on it? Just it doesn't make any sense. So like we want to get things done to get paid, and I think people appreciate that, and I also think like we hire a lot of ambitious bankers that want to upend kind of a market of elitism and and people like that. Like if you think about banking, how they do hiring, they only hire out of certain target schools that did certain logos, and private equity firms only hire at certain banks, and I think that whole thing is ridiculous. And I wrote about it they wrote about it in the Financial Times towards the end, but I talked about it. We like to do meritocracy here. Like we use a software platform called Merit First for some of our hiring for bankers. Like we'll send this test out, and I think that's something I care about. Is like, I don't care where people went to school, what they what internships they did or what companies. It's like the only thing I care about is like if someone's smart, we're hardworking, good person. What we're doing is not rocket science. We're not performing open heart surgery. Like you don't need someone with certain certifications and qualifications. Like what you need is just smart people,
Right.
hardworking people, personable, that care, and that you want to work with. That's really what I care about. First, a lot of these banks, they optimize for logos and elitism and who your parents are, and I just think it's kind of wrong. I think in society it's pretty bad as well. I mean, it happens everywhere. It's just unfortunate reality, but I think it's really bad. And I hope at Offdeal we can kind of upend that, and because I do a lot of interviewing with people. I meet a lot of different people, and I wish I could prove this out in stats, or if I have time, maybe I'll do it someday. But I don't see any difference in intelligence or like successful people that worked at the big companies to the small companies. Like it's just because you worked at a J.P. Morgan or something or a Morgan Stanley doesn't mean you're smarter than someone that worked at a bank you never heard of. I mean, maybe
Right.
they wanted to work at a bank you never heard of because they wanted to be close to home, or because they had a lot of responsibility, or maybe they got paid more. Like it's actually, if you work at a boutique investment bank in Minnesota, for example, you
Mhm.
make more money after taxes and adjusting for cost of living than a banker in New York City
Wow.
at the analyst associate level. It's just true. I mean, you can do the math. I mean, you get an analyst at a boutique will get paid almost edging up to 200 grand. Well, the cost of living, you get a studio for $1,500, and the taxes are lower. I mean, you're raking in money versus here. That same job pays the same base and same bonus, but you're getting taxed way higher, and your cost of living is at least doubled, maybe even more than doubled. So I don't know. Is someone smart for working at a JP Morgan doing that, or working in, Kansas City or Minnesota or Wisconsin? I don't know. You could definitely make the argument for that. And then these are all like second derivative problems. So like, if you have really rich parents and like you come from elitism, of course you're gonna work in New York City at the big
Mhm.
logo thing. But if you're come from not much money and you paid for your own college like me, 90, 100 grand, whatever it is, you're of course gonna work in the Minnesota's because of the world, and Wisconsin's because you can save up money, um, uh, pay whatever, So that's the thing is like people need to think critically when about people and their hiring and the background. It's not just they worked at you know Bank of America, they must be a genius because it's a big company, and it's like it doesn't work that way. Like there's a lot of reasons for how people get jobs, why they don't get jobs, why they choose certain jobs. It's the same thing with schools. Of course, maybe at the odds, people that go to Stanford or Harvard are smarter than people that go to like a community college. Like I'll give you that, but I don't know, but like just because someone went to these schools doesn't mean they're smarter than someone that went to like a state school. Like there's just so many reasons why people get into college and how it works, and like I aced my test scores. Does that mean that? Yeah, but I chose to go to Minnesota public school. Why? Because I grew up there. Because all my friends were there. My girlfriend was there. I didn't want to go to out east and do that, but and so it's like not everybody wants to do go to this stuff, and so I
Right.
think it's really important part about off deals how we hire, and I think that's not really reported a lot, but that's an important part to me is that.
That actually makes a lot of sense. And yeah, we like really appreciate the transparency because I studied finance as well, and like I've seen some of the things that you're talking about. It's very common here in Australia as well, and I was in the US last year. I did a semester exchange. Oh, like the nepo kids. Like the thing
Yeah,
is real. Like I underestimated how much of an impact like your last name can have. But I get what you're saying. And in terms of I guess social media, uh, the outreach that you guys do, I think the biggest hope for both me and Rehan was a tweet by Ori where he asked the simple question, how would today's Goldman Sachs or Evercore look like? And that was the thing that got us interested in Offdeal story as well. So
right. Yeah.
we see how I think we can see how clients would like organically be drawn towards Offdeal rather than the big banks.
I agree.
Right,
Y-
Sam. Yeah. Before we let you go, just a quick sort of personal question because both of us one day want to start something of our own, and we can see that you're someone who likes building, that going from the 0 to 1 journey. Um, so if you went building off deal right now, what would you be building?
Good question. I would be building a residential security company. So if you think about residential security for homes, the biggest player is a company called uh, why am I blanking on the name? Public company. One sec. I gotta. It's gonna drive me nuts. Um,
Are you talking about Ring that was acquired by Amazon?
no, Ring's up there. Uh, this company owns 19% of the market share. Um, it's a blue logo. It's like a what's it called? I'm asking ChatGPT. Oh, ADT. So ADT is a public company. They own about 19% of the market share. There's Ring. There's like Vivint. There's uh, that Guardian Protection, some of those, but it's one of the most fragmented industries. Like a couple guys at the top, and then a bunch of small. There's hundreds and hundreds like small little like residential security companies that will install like crappy Best Buy cameras and stuff. But if you think about residential security, why did I say this idea? Because the NPS score for residential security companies is one of the most negative, meaning like people are unhappy with it. Like a Ring camera, Amazon bought it, like great idea. It's a great start, but it's a camera. It just records crime. It does not stop crime. Like the Minnesota murders of the politicians recently. Of course they had cameras. It doesn't
Right.
stop anybody. It just records it. And so if I were to start a company, it would be an AI residential security company. It would be, um, you would have drones. Maybe you deploy drones if like the AI cameras depicted it's like a robber or someone's face. You'd use facial recognition, right? Maybe it's you put a spotlight, so you have like cameras that like do large sirens like a spotlight and like follow them around, right? Maybe it's a system that like automatically calls the police if it identifies something. This would be like basically like Anduril, but for residential homes. And I think it's something I care about because I think crime is increasing. I think people want to feel safe in their homes. I just find it hard to believe that for the next 20 years, the only solution to home security is going to be a Ring camera or some camera system. I think it's going to be the next big consumer product is going to be, something for the homes. Like you see, like Verkada is like commercial security. They're a big startup. A lot of people like commercial security for obvious reasons, like commercial better, you can
Right.
charge more. But I think in terms of like impact and like what's untapped is definitely residential security. Fragmented. I mean, someone should easily just displace ADT in a second. And you know, I think I think you could I think you would start this business idea at the luxury end of the market. So you would probably have this be like a premium product. So you'd go to like rich people houses and say, hey, you got a $10 million house
Hmm.
and you got family you want to protect, and why do you just have a Ring camera? Like let's install
Right.
some drones, some spotlights, and that's what I would do. And then you could work your way down, right? But that's the idea I would do. optimistic on it. I don't really think many people are doing it. The tough part about it is you need like AI engineers to build like hardware and like the software and drones. Like it's a little outside my expertise, but in terms of like business and sales, like I could smoke that thing like that. I could grow it up, build it up so fast. You just need to get the tech right, but it couldn't be too hard. But that's the idea I'm really optimistic about.
Right. That's that's great insight that you have on that use case.
Yeah.
Thank you.
I
Thank you.
think that gives us our next article
Yes.
Yeah, could
for
be. I
phone
have a lot of
security.
ideas on it. I have like a deck. I mean, it wouldn't be software. Like I just feel like there's so many software companies out there. Like obviously a lot of them grow and they raise all this money, but like I don't know. I just feel like it's really tough. Like I tried to do that. Like before the Finley thing, I tried building like a HR tech idea and like I don't know. I just feel like a lot of these things are like VC propped up. You know, they raise a bunch of money and then they spend so much in sales marketing and they get like revenue, but they're not like profit. I don't know. I think software is kind of tough and it's not really that fun for me either. But I think like a hardware company or like some service is kind of up my alley and fun. And yeah, I think the residential security one could be big.
Right. I believe that hardware also is waiting for its ChatGPT moment. Yeah.
Oh
Just
yeah, I mean robotics will be big. I mean it'll be really big. Yeah, I think it's timelines aren't going to be as quick as people think, maybe, but I think it's really fun. I'm pretty optimistic on robotics. I think Waymo is like super fun. I mean, I wrote that about that in my book, but like I'm very optimistic on all those. And um, sorry, this is fun, but yeah, I'm optimistic on all that. Waymo, transportation, flying cars too. I think um, I wrote about this in my book, but like EV tools, like Joby and Archer are the two biggest companies there. Doing good in the public markets recently, but that's another thing where 99% of the public has no clue what they are, but they will in like 5, 10 years. It'll kind of have its like Waymo moment. I think those are gonna be good. Kind of Uber for the skies. I'm pretty optimistic on that. I think personal home robotics will be fun. I think healthcare has a lot of innovation there, but I think see if that ever gets fixed. But there's a lot of ideas out there, but I think one company I'm optimistic about is like Harvey AI, Law AI. I think that's like the one kind of chatbot slash like software company that I'm pretty bullish on. Because like AI is perfect for legal. It's all text in, text out, reading documents. So it's like perfect for AI, and it seems like they have pretty good lock in with a lot of the law firms, and that's all you need. So I'm pretty bullish on Harvey. Um, yeah, but yeah, let me know if you guys have any questions. I can answer them over LinkedIn or email or text. It'd be pretty fun to catch up again soon.
oh, sure.
Yeah, definitely.
Yes.
Thank you so much for taking the time today.
Thank you. See you guys.